Welcome to Bloomberg Markets. I'm Shanali Basak. Volatility hits global markets, but indices are starting to turn. Actually, the Philadelphia Semiconductor Index actually just turning positive on the day, so some of that fear really abating. Let's get a check on these markets. The S&P 500 off of session lows, only down now about 1.8%. Down nonetheless. Remember, the NASDAQ 100, if you woke up early this morning, you saw futures turning as low as 6% lower. A lot of those losses really starting to be paired at 1.5% lower now on the day. The Russell 2000 still seeing a little bit more pain, 2.2% lower. But remember, if you look at the last couple of sessions, you actually saw the NASDAQ 100 down more than 2% the last two sessions. Today, you're actually doing just a little better than Russell 2000, down more than 3% the last two sessions, now only down 2.2%. The Philadelphia Semiconductor Index, as we said, turning green. Flip up the board here. Let's look across assets because the VIX is still above 30, certainly higher than it has been most of the last year. But we did earlier today touch 65. Those are very rare levels, not historic levels, but rare levels nonetheless. The 10-year yield, the interesting thing here is the bond market starting to turn around. We saw the 2-10s curves invert or disinvert a little earlier today. Flip up the board here one more time and show you exactly what's happening across the curve. Yes, there is a little movement, but the short end of the curve is stunning. You are seeing now a 5 basis point rise in the 2-year. This is a part of the curve earlier today that had been as low as 364. That means we have jumped more than 30 basis points from peak to trough today. We are hanging out now nearly 5 basis points higher at about 393 on the day after that ISM data and more market moves. Let's go turn to Abigail Doolittle for a look at some of the midday movers under the surface as well.
Well, Shanali, it's really pretty interesting because on a regular day, if we were taking a look at this board, we would say it's pretty bearish. But given the fact that we are at the lows, to your point, the S&P 500 at the lows down more than 4%, the NASDAQ 100 futures overnight down 6%. Now those indexes really having their worst day in just a few days because of this risk-off period we're in. But take a look at the big decliners. The pressure today really coming from the chip space earlier, but we do still have Intel and NVIDIA lower. But earlier, NVIDIA had been down 13%, too far, too fast. This AI rally. Intel, of course, last week reporting a disastrous quarter. That stock on the year over the last 12 months down more than 70%. Apple and Supermicro Computers. This one's actually flipping, but Apple's interesting because that chart clearly points to the idea of going sub 200. NVIDIA also looks like it's going to go lower. But right now, sellers taking a little bit of a breather. We're not seeing any kind of panic. What we are seeing is a lot of breadth to the selling action. Berkshire Hathaway, which reported over the weekend, talking about selling much of that Apple position, much of that selling starting at the end of last year with the stock in a correction. Apple in April of this year, this stock down about 2.7% despite the stockpile. Really a tell on the S&P 500 overall, but it's also healthcare, it's energy, and it's also retail investor selling. But you made that interesting point about the stocks turning green. So let's take a look at some of the stocks that are helping out the S&P 500 come off those lows. And it's all about the chips. Lam Research, the semi-cap equipment company, now up 3%. Advanced Micro Devices, which had been down sharply earlier, up 4.6% on up about 5%. So you see some bargain hunting in here, so to speak. And then there's one stock on this board that's not like the others. That is Kellanova. Shanali, the snack maker, up about 14% on some buyout talk. So it's not all bad at this point. We do have some green, but for the most part, we're still under pressure for stocks.
Abby, we thank you so very much. We're going to discuss this market more with Bloomberg Opinions Nir Kaissar. And Nir, we've been talking about some of the sentiment over the surface. We've been talking about that slow drip of selling we've seen in the prior weeks. Has something changed after we saw the payrolls report on Friday and after we saw the unwinding of these carry trades head into Monday?
Hi, Shanali. It's certainly possible. I mean, the first thing I would say is we need to be mindful that every 18 months or so, there is a correction in risk assets. In the stock market in particular, this is healthy. This is good. There are excesses in markets. We want them to be taken care of. And so what we might be seeing now is a garden variety correction. We were last time I looked in correction territory in the NASDAQ. That's probably healthy given where valuations were. And that may spread over into the S&P 500. I think people are asking a different question this morning. the turnaround in markets notwithstanding for the moment, which is, are we on the precipice of something bigger? Are we on the precipice of either a systemic event or a systemic shock, let's say, or a valuation-based repricing across the broad market? So that would be something like the 2002 period. A systemic shock would be something like the 2008 financial crisis or pandemic. I don't think anyone sees some systemic shock on the horizon now. Oftentimes, markets are ahead of us. They know things we don't know, and so that might be revealed. I don't personally think so. I think that it's possible if this gets out of hand, if this goes longer than anyone thinks, then I think it's probably a repricing, which in certain aspects of the stock market we have long been overdue for. Keep an eye on the VIX and see. I mean, as you mentioned up front, the VIX was really high this morning, has receded a ton. That may signal a garden variety correction, but we will know this week for sure.
So are we out of the woods? You mentioned systemic and the worries about something being a little broader based. Where is the worry here? When you see a broad deleveraging like this, I think one worry that is immediately underpinning the market is, where's the floor?
Right. And I would say the most likely outcome, in my opinion, is some sort of repricing that's valuation based. That might have to be more severe than a correction. One way to quantify that is to look at the forward earnings estimates for companies, individual companies, let's say in the S&P 500. And in general, when you look at those, what you'll see is when you take their growth into account, in general, the pricing tends to be roughly along the lines of the historical PE for stocks in general. So when you look at different PEs today and you see that one is 50 and one is 10 or whatever it is, usually the difference is in expected earnings. So if you look at expected earnings and you look at those PEs, one simplifying question you can ask yourself is, what does the decline have to be in order to get to the long-term average PE of, let's say, somewhere in the range of 16 to 19 for all of these stocks, taking their growth into account? My guess is it's some number less than the S&P 500, but I'm actually going to be running those numbers this week. And so we'll see what they say. But my best guess for you right now is that those numbers are going to say that we need some rethinking of the multiples that we've seen in the S&P, and we're in the process of repricing now.
It's interesting. Even today alone, Nir, you have had, obviously, people step into this market and say, hey, I will catch that falling knife. At what point do you start to buy into these opportunities?
Well, there's several ways you could do it. I mean, what you want to do ideally is you want to look at some sort of mean variance analysis, right? You want to say, okay, here's an average and here's a standard deviation, and where am I far enough out? 2 sigma, 3 sigma, where I can be comfortable that if this gets ugly, ugly has already occurred. This is an important question because during the financial crisis, that took more than a year to get to. The high of the market was October 07. We didn't bottom until March of 09. During the pandemic, however, the whole thing unfolded in about 4 weeks. So it's really not enough to look at it in terms of duration. You have to look at it in terms of severity. And I would say if you want the simplest heuristic there is, it's just decline in the S&P 500. A bad decline is a 40 to 50% decline. I think we're probably at about 5 to 6% last time I looked. So if you're looking to bottom feed, to catch bargains, whatever phrase you want to use, I don't think we're there yet.
So what about the bond market? You saw that massive bid come into the bond market this morning, and it was really the only haven bid you had. A lot of that has been erased already. At what point do you find entry levels in the different parts of the yield curve?
Well, it depends on what you're after. I mean, in general, my buys tend to be in favor of credit premiums and not term premiums because interest rates are very difficult to predict. They're very unstable. And in general, the term premium tends to be not high. And in fact, in this environment, it's negative. So that might change. You mentioned earlier the disinversion. So investors should definitely keep an eye on that. But if I were looking at the bond markets, I would keep an eye on the credit premiums. They've gotten very shallow recently, probably overbought, and they will widen for sure. Certainly they widen during recessions, but they tend to widen also during garden variety corrections. So that's what I would keep an eye on, both as a signal of where the value is in the bond markets and also as a signal of what we're looking at. Is it a correction? Is it a systemic event? Is it just a repricing?
The chances of a recession, something that looks a little bit harder than the soft landing that investors had initially expected. You watch Goldman bringing up their recession odds, not to alarming levels, to 25%. Do you start to think differently about what a landing could look like here, and if it's a little bit harder than what you initially had planned for?
Well, I mean, I think we have to be open to that possibility, but I think we also have to be mindful of the numbers in front of us. And the first thing I would say is we need to disconnect the market from the economy, because the market doesn't always necessarily follow the economy closely. But we do have a set of numbers in front of us, and the market can be a leading indicator, but it can also be a false flag. And so my advice would be to look at the numbers in front of us and see what they're telling us. And I think in general, when I look at it, I see inflation heading to a good place in general. I see unemployment that's still relatively low, moving higher, but still relatively low. I see GDP numbers that are relatively healthy, although the GDP now numbers put out by the Atlanta Fed, that's something to keep an eye on as a more real-time indicator. But for me, it's way too early to say that we have not had a soft landing. I think that what the Fed has done so far has been extraordinary, given what's happened to the economy. And I think it's too soon to say that we are falling off a cliff, economically speaking.
As always, near cooler heads prevail. That is Bloomberg Opinions near Kaissar. We thank you so very much, of course, for joining on this crazy Monday of trading. Now coming up, shares of Semenova rising to intraday highs not seen in more than 35 years. Snack company Mars is weighing an acquisition, and it's our stock of the hour up next. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak, and let's take a look at where markets are moving at large here. We had that Philadelphia Semiconductor Index in the green for just a moment. We are back down. These moves have been swift and volatile. The Russell 2000 now really more in line with where you're seeing declines in the S&P 500 and then the NASDAQ 100. It is the third day in a row you're seeing NASDAQ 100 declines of more than 2%. We're going to talk more about these markets with Bloomberg Equities reporter Alex Semenova, who has been reporting on these market moves and very close to the strategy community. And it looks like after so long, the bears are out to play.
Yeah, absolutely. So it's very important right now to distinguish between the near-term view and the long-term view. So the expectation right now is that things could get worse before they get better, right? The VIX soared to as high as 65 earlier today. It has since retreated, but that is a level that we haven't seen in years. So a lot of this selling is caused by, volatility tracking funds selling off their positions. That can always exacerbate the kind of route that we're seeing today. So that might continue over the next few days, especially with there's so much uncertainty about the outlook with the Fed, the economic data disappointing a little bit. But the overwhelming response I have been getting when I have been asking traders and strategists about their fundamental view is that so far it hasn't changed. So when you look, obviously this disappointing jobs report, but we aren't seeing any kind of mass layoffs happening right now. GDP came in at 2.8% in the second quarter. Earnings are still good. They're broadening out beyond the Magnificent Seven stocks. So the fundamental case is still intact, especially with a Fed that is prepared to cut interest rates. So once we get through this kind of seasonal weakness,
what are they saying specifically about these kind of tech-heavy names, this Magnificent Seven stocks, the semis, NVIDIA?
So we're really seeing the perils of this concentration risk that everyone has been talking about, right? It's been a very top-heavy market when, so many of the gains have been led by the so-called Magnificent Seven stocks. And so when we do have these elevated valuations, any kind of, sense of uncertainty about their direction, anything that sours the sentiment could lead to very steep losses like we're seeing in tech. And that is kind of, bleeding out into the rest of the market. But so far, again, when this recovery happens, the picture still looks good for those names. They are still delivering on earnings, and the economic outlook is still solid.
We lost a prominent bear at JP Morgan recently who has been following the market. What does this mean about the leaning of the strategy kind of portion of Wall Street here? Do they feel any pressure to buckle?
Yeah, it's been really quite interesting. A lot of sources have been reaching out to me saying that isn't it interesting when you have the most prominent and outspoken bear on Wall Street leaving the firm, now suddenly this happens. Sometimes that serves as kind of a contrarian indicator. Remember, he is someone who, when he changed his position from bullish to bearish, the stock market soared after that. So the same way he leaves the firm, and now this is kind of a change in sentiment. Exactly. So, but you still have JP Morgan maintaining its bearish stance. The strategists there, now led by Dubravko, Lycos, Bujas, still have that 4,200 target on the S&P 500, and they're saying that their concerns about an economic slowdown are starting to play out.
Thank you so much. That is Bloomberg's Alex Semenova. We're going to switch now to talk more about the stock of the hour, taking a look at shares of Kellanova, the snack spinoff of Kellogg's. The shares are having its best day in 36 years on the heels of M&A rumors. Mars weighs expanding its candy and snacking empire with the buyout of Kellanova, according to Bloomberg sources. And analysts are reacting positively to the news, with one saying that a merger could boost valuations. Both companies have declined to comment. And joining us now for more on this story is Bloomberg's Michelle Davis, senior correspondent over here at the deals desk for us. And you look at this Kellanova deal. What are some of the complications? This is a company that is kind of newly standalone, isn't it?
Yeah, so Kellanova completed its spinoff last year. It's been an underperformer among peers. You know, the multiple is down compared to peers, but it has been outperforming on a sales perspective. Some of the hurdles are obviously antitrust. Anytime you have a big deal like this, it's guaranteed that regulators are going to want to take a look. Analysts are saying that Mars doesn't have too much overlap with Kellanova the way some of the other, consumer packaged food companies would have. But in an election year, anytime there's a big splashy deal, big numbers, consumer facing, there's always, the risk that the presidential candidates talk about it. You just run the risk of it becoming a talking point. And so that's something that could make it harder for the deal to get through,
especially
if it does get announced.
In a consumer-focused company. What about the rationale for Mars? Is there a significant rationale besides valuation? And how do investors feel about it?
So for Mars, a deal for Kellanova would help it expand its geographic footprint, but it would also help it expand, as you said, beyond its bread and butter, which is candy bars. They make the Mars bar, they make Snickers. Kellanova is all about the salty snacks. They make Cheez-Its, Pringles, and so this would help them expand into that lucrative area, especially as, chocolate sales have come down.
Fascinating. That is Bloomberg's Michelle Davis. Of course, when this M&A market is just coming back and deal talks in a volatile market nonetheless. Coming up, some traders are betting on an emergency rate cut from the Federal Reserve, but there are others who say no way. We're going to discuss exactly what's happening there next. This is Bloomberg. This is Bloomberg Markets. I'm Shanali Basak. We want to get a quick check here on the stock market once again because the intraday moves have been stunning. We have the S&P 500 that are off session lows but dipping lower once again on the day to 2.5% nearly on the day, and the NASDAQ 100 dropping in synchrony. The two-year yield, we're watching at it up now just about 2 basis points at 3.9%. We had hit as low as 364 earlier today. From peak to trough, we've had a roughly 30 basis point swing, just staggering. The 10-year yield now flat at around 379. Now, investors are betting that the Federal Reserve will turn more aggressive in cutting interest rates amid mounting signs that economic growth is faltering. But Bloomberg Opinion's Marcus Ashworth says an emergency rate cut would be a mistake. And he joins us now as well. And Marcus, you think about this idea of an intermediate cut. What would it really take to get here? Because isn't the worry at the end of the day that if they did step in and cut drastically or at all before that September meeting, would that not be a sign of weakness?
It would be. It would be a moral hazard, as a comment you made earlier, because at the end of the day, this is a remarking of the yen. I mean, why would the US want to panic itself over what was an overly weak yen, and indeed a move done by the Bank of Japan to correct that slowly but carefully over time. And a lot of that, unfortunately, that yen carry trade is because people have been borrowing yen and buying US tech stocks, which have been overbought for almost as long as I'm old. But I mean, they have been going on and on. At some point, they need a reckoning. That is not the Fed's job. Yes, we know about the Fed put, but that's if stock market weakness really revolves into proper economic systemic issues, as we may have seen, obviously, with the pandemic, or we saw financial crisis. So
here's my question about this as well, because on one hand, if you have a carry trade unwinding and unclear how far that goes, margin calls do take a couple of days to really start hitting the tape and processing, and therefore really the extent of the pain is today unknown. And at what point, when you see all the retail money that has gone into these large stocks that were otherwise also involved in the carry trade, at what point does that become a bigger problem?
Well, no one knows, and the point here is that this is not what the Fed is job is to do. There are liquidity problems, and that's, I think, one of the reasons why perhaps this has come a little bit harder. Is the Bank of Japan also announced it's going to cut back by half over the next 2 years its own purchases of JGBs. They've been providing liquidity to the world for many years. Again, they needed to scale back on that. Perhaps we might see them slow that down. That will be really not the Fed's job, but the Bank of Japan's job, although I'm sure they talk. Look, the Federal Reserve needs to cut interest rates. Absolutely. Could it and should it have cut last Wednesday? Well, possibly on reflection. Certainly it should cut on September 18th. It doesn't really matter if it's by 25 or 50. If it's 50, then great. If it's 25, but it needs to come with a little bit more surety they're going to be, not necessarily cutting every meeting, but they are certainly going to get on with lowering overly restrictive rates, which they know they're at, down to a level which is more personable for a steadily slowing economy.
To that end, we have only about 30 seconds left here. How more concerned are you about a recession today than you were maybe even a week ago?
Less. Services ISM is showing that there's actually a little bit more recovery in the services sector. The payroll number wasn't great, but it wasn't terrible either. We have a hurricane effect that could possibly affect it. I think recession is a potential, not for a while yet. I think the corporate earnings season and GDP growth nowcasts are pretty strong. The Fed does need to panic, and it shouldn't panic into meeting.
Once again, cooler heads prevail. Bloomberg Opinions, Marcus Ashworth, we thank you very much for your time. And don't miss his column on Bloomberg.com and on the Bloomberg Terminal, one of the most read today. And I'm Sonali Basak. That does it for Bloomberg Markets. Stick with us through the close, though, because, of course, it has been an absolutely stunning day of trading. Not as low as we were before, but lower nonetheless. This is Bloomberg.